There's no doubt about it. So far, 2022 has been a tough year for the average investor. Even though the S&P 500 is down about 16 points, cryptocurrencies have been wiped out. And the housing market is slowing down. Price changes have been caused by the same two significant macroeconomic factors that you have probably heard a lot about in the news. Over the past year, inflation and interest rates have been high. During the lockdown timeframes of 2020 and 2021, the Federal Reserve printed about $4 trillion to help businesses and people. This helped in the short term, but it also caused inflation to reach its highest level in 40 years. If inflation is left alone, it will only get worse. Welcome back to Market Empire. Over the past year, the Federal Reserve has had to hike interest rates, which limit consumer spending by reducing people's access to credit and disposable income and hence slow down price inflation. That's the lengthy version of why inflation will be so high at 7.7% by the end of 2022, even if supply and demand have recently normalized. It has slowed down a bit recently, and interest rates have risen to between 3.75% and 6%. So with that background established, let's talk about how we should approach investing in 2023. Can you tell me what aspects we must evaluate? It may seem like a cop-out to say that the first thing we need to do is handle the first item, but that's not the case. If you're planning to invest in 2023, the first thing you should ask yourself is whether or not you have the financial means to do so. While investing is excellent and all in the short term, your portfolio could go up or down depending on several factors. To be a good investor, you must be in the market for a long time, say 5 to 20 years. They don't simply change their mind. Great investors tend to keep their money in the market for a long time, so it's important to avoid using savings for necessities and instead put it toward long-term goals like investing. Put that thought and that money out of your mind if you need it to pay rent, bills, or anything else. If you haven't already noticed, the top firms in the world are laying off workers because of the rise in interest rates. This raises the question, do I have an emergency fund? To what extent do I have financial stability over the next year or two? Because recessions are fantastic for new investors to get in, but they aren't very nice to workers. Therefore, you should evaluate your financial circumstances or consult a counselor before answering these questions. As we've already mentioned, interest rates are the second thing to consider. While there are encouraging signals of inflation moderation and the Federal Reserve may moderate the rate of interest rate hikes, it appears that we will be operating in a high interest rate environment in 2023. Certainly much greater than we've witnessed over the past few years. What does this signify for investors? High interest rates are alarming for the stock market because they make it more difficult and expensive for firms to make money. Companies are seeing less revenue growth as the cost of opening new outlets rises, and consumers have less disposable income to buy the goods and services that drive their businesses. We intend to pursue real estate investment opportunities. When interest rates rise, borrowers with variable rate mortgages must pay a larger portion of their income toward principal and interest payments, reducing investors' returns. In addition, rising mortgage rates have a domino effect on the housing market, forcing more homeowners into the market and putting downward pressure on home prices. To make informed investing decisions, you should know whether or not interest rates will continue to rise in 2023. It's a fair question, and the Fed has promised to maintain a tight monetary policy until the inflation rate falls to 3%. However, how long that will take and how many interest rate hikes will be necessary are entirely unknown. Inflation and interest rate trends are vital to monitor, but their unpredictability means that you should always return to evaluating investments solely on their own merits.
Stocks are not lottery tickets. There's a company behind every stock. If a company does well, the stock does well. It's not that complicated. People get too carried away. And first of all, they try and predict the stock market. That is a total waste of time. No one can predict the stock market. They try to predict interest rates. If anybody would predict interest rates right 3 times in a row, they'd be a billionaire. Considering there's not that many billionaires on the planet, logic, so I had a syllogism and studied these when I was at Boston College. There can't be that many people who can predict interest rates because there'd be lots of billionaires. And no one can predict the economy. I had a lot of people in this room were around in 1981 and 82 when we had a 20% prime rate with double-digit inflation, double-digit unemployment. I don't remember anybody telling me in 1981 about it. I didn't read, I studied all this stuff. I don't remember anybody telling me we're going to have the worst recession since the Depression. So what I'm trying to tell you, it'd be very useful to know what the stock market is going to do. It'd be terrific to know that the Dow Jones average a year from now would be X, that we're going to have a full-scale recession, where interest rates are going to be 12%. That's useful stuff. You never know it, though. You just don't get to learn it. So I've always said, if you spend 14 minutes a year on economics, you've wasted 12 minutes. And I really believe that.
Each company needs to be evaluated on its own merits. The data support competitive advantage. Consistent increases in sales, profits, free cash flow, and equity indicate competent management. How well do they manage their debt levels? Is there a good rate of return on investment? In addition, how much is this company worth? And is there a discount on the shares we want to buy? Thirdly, you should think about the business themselves, not the macro. And finally, there's the elephant in the room, your personality. Buy low, sell high. The stock market's fundamental tenet. Most people, however, operate oppositely. They make a habit of buying high and selling low. People panic and sell at a loss when the stock market suddenly drops and the news becomes negative. This is a common cause of market crashes. Suppose you want to be a very successful long-term investor. In that case, you need to control your emotions and not act on them. Since 2023 might be another year for investors, especially if one wave of selling scares the following wave of people into selling. However, with inflation and interest rates as they currently stand, along with widespread layoffs, it's possible that this coming year could be another challenging one for the economy. Perhaps, if inflation becomes too high, the Fed will decide to decrease interest rates. It's essential to think long-term and only invest money you won't need for the foreseeable future so that you're ready for anything. To invest well in 2023, they will be essential components. The stock market could be volatile, so it's important to keep your emotions in check after seizing opportunities and keep your eye on the long term rather than the short term. For the most part, volatility is beneficial to long-term investments. Though it may sound simple, training yourself not to panic in the face of adversity is a skill that must be honed over time.